Hello everybody and welcome. This is Tushar Chande. The CPI data released today, July 11, 2024, were weaker than expected. So there was a big reaction in the market, and in particular, the market seems to be now betting on a rate cut in September. How likely is that and why is that? So let's dive in and find out. A gentle reminder, past performance is not necessarily indicative of future results. This is the year-over-year change in the CPI data. The most recent reading released today was for 2.97%. So now we are below the lower band and we are at the same level as the June value. So ideally in the future, we'll continue to go lower, which is very good news for inflation. This is the probability of a 25 basis point cut in September using the CME Fed Watch tool. The number here is 84.6%, which means that the market is assigning a 85% probability, let's say, of a 25 basis point cut in September. This is fairly typical from Reuters of the reaction of San Francisco Federal Reserve Bank President Mary Daly. She now believes that one or two rate cuts are appropriate after today's data. And she actually points out a very subtly important detail. She says that it's fairly big communication signal that you hear so many of us, and Chair Powell importantly, talking about how important the labor market is. So the changes or the weakness in the labor market is pushing the Fed to consider lowering rates in combination with the lower inflation data. So why is the Fed worried about the labor market? Let's look at that next. To understand why the Fed is worried about the employment situation, one needs to understand the Sahm's rule. Dr. Sahm was an economist at the Fed, and she derived this rule to identify the start of a recession. It is a three-part test which says that when the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more relative to its low during the previous 12 months, then we have the start of a recession. So let's break that down. So this is how we can break down Sahm's rule. We first calculate A as a 3-month average of U3, the unemployment rate. Then we compute B, which is the 12-month minimum or the 12-month lowest low value of A. Then C, we take B and add half a percentage point or 0.5%. And then we ask the question, is A, the 3-month average of U3, greater than C? So this is how we can visualize the Sahm's rule for recession onset. We first calculate the blue line, which is the 3-month simple moving average of the unemployment rate. Then we calculate the orange line, which is the 12-month lowest value of the 3-month average unemployment rate. So it's the 12-month low for this blue dotted line. And then to this line, we add half a percentage point to get the red line. So the red line is the trigger line. And when the 3-month moving average rises at or above the red line, then that's considered to be the start or onset of recession in real time with Sahm's rule. So here's the state of play as of last Friday's data. So the red line is currently at 4.07% by my calculations, and the 3-month moving average is at 4%. So we're just at or above the Sahm's rule line. Now there's some question of exactly what data you use, and the Fed's value is slightly different. So let me show you that. So this is via the Fed economic database from the St. Louis Fed. This is the real-time Sahm rule indicator calculation. They don't make any adjustments, etc. So their value is at 0.43, so just below the 0.5 threshold, whereas my data are just above the 0.5 threshold. But either way, the lesson is, or the message is, that we are approaching some criticality level using the Sahm rule, which might indicate that there could be an onset of a recession. So how did the market react to the data? The possibility of a rate cut is good for small and mid-cap stocks. So VIOO and IVOO and V2, which all have mid to small cap stocks, all rallied strongly. Mega cap stocks were down a little more than 1%, and the QQQ was down more than 2%. The S&P itself was down about 0.9%, and bonds rallied. So the probability of a rate cut rallied bonds, small and mid cap stocks at the expense of the mega cap stocks. So this is daily data for TNA, the direction small cap bull 3x ETF. The lower panel has the chats or Chandey trend strength indicator. It's still below 70, so the uptrend is not strong. This is the Chandey arch indicator, which is the automatic regression channel. The inner bands are plus minus 1 standard deviation. The dotted bands are plus minus 2.5 standard deviations. So you see, we have been going sideways since November of last year. Today we had a strong up day. We just closed above the inner channel. Now we're in a resistance zone. We're now up to the dotted line. And previously we've been selling off when we get to the top of this range. So resistance now a little bit above 43, let's say. This is daily data for QQQ. In the lower panel, we have the chats indicator, the Chandey absolute trend strength. It's above 75, so the trend is up, even though we've come back a little bit today. This is the arch indicator, the automatic regression channel. The orange bars here is plus or minus 1 sigma. The dotted lines are plus or minus 2.5 sigma. Notice we have support here at the lower band and resistance here at the upper band. And perhaps we'll have a pullback somewhere towards the middle of the range, say around 479, 480, and perhaps the trend can resume from there. This is daily data for the S&P 500 index in the upper panel, and my preferred complex momentum oscillator down below. The scale is plus 300 to minus 300 during strong uptrends with values of plus 300. So today, even though we had a sell-off in mega caps, we had a rally in small and mid caps. So the combined result was to give us a value of 300, which suggests that we could have the start of a strong uptrend for the next few weeks. So the tools I've used here are at trendspider.com. You can find my tools with this link here. I hope you like and subscribe, and thank you for listening.